There's only a couple more weeks of the year now, and as the housing market chills out over the holidays, all eyes are on the spring market. So let's take a look at the data as we wrap up the year, and I'll highlight the key data points I'll be watching starting in January. Here in December, inventory is declining pretty quickly. It's seasonal decline, of course, but this year inventory seems to be tidying up more completely than in any of the recent years. Market velocity with both new listings and weekly new pendings reported a pretty low week this week. Both data points actually came in slightly fewer than the same week a year ago. This is only 1 week in the middle of the holiday season, so it's not a trend, but it bears watching. When we look at the monthly and 3 month trends, both the weekly new listings and weekly pending sales are pointing to growth, but this week dipped for the first time in a while. So I'll be watching these two markers as we roll into the new year. My expectation, frankly, my hope, is that both climb. A healthy housing market has more sellers and more sales. The recent price trends that we've documented are also continuing. So we'll take a look at the latest home price signals today, too. All right, let's start with inventory today. There are now 775,000 single-family homes unsold on the market. That's 13.7% more than last year at this time. Recall that earlier in the year, the inventory was growing by 30% over last year. Now it's only 13% greater than a year ago. So in 2026, we expect to see continued moderate inventory growth at about a 10% pace for the year. This week, there are 20,000 fewer single-family homes on the market than a week ago and 40,000 fewer than the start of the month. So some of that inventory is from sales. There are usually more sales than new listings in December, but it's also due to withdrawals over the holidays. So it's totally common for sellers who don't have an offer to take a home off the market in December and relist again in the spring. Withdrawals spike over the holidays. This year, however, has had notably more withdrawals all year than recent years. If you saw our 2026 housing market outlook report last week, you'll know that this year's withdrawals are a big variable for understanding how next year's housing market will play out. It's very tempting to look at the withdrawals as future inventory and only see the supply side of the dynamic. But I'm looking at this data, this withdrawal data, as mostly owner-occupiers. That means that each withdrawal is a sale and a purchase. It is indicative of pent-up demand for housing if we get lucky and the conditions improve in the first half of the year. So in this chart, I have 10 years worth of inventory patterns, and you can see each year's seasonal curve. The gray band is the old normal levels of inventory, which we're in now. It used to be common to have over 1 million single-family homes on the market in midsummer. We might touch that level next summer. So here's what to watch in inventory in Q1. So we're expecting continued growth in inventory, but much slower than we saw in 2025. If inventory levels surge quickly, that means these withdrawal listings are more representative of supply than demand. But if inventory continues to grow moderately, that's in line with our expectation for flat prices and slightly improving transaction volume. So that's what we're keeping our eye on in inventory. The same home price pressures that we've been documenting for a while are still on. The asking price per square foot is about 1.5% below last year at this time. I've been using this chart to illustrate price trends because it is the most clear of what's underway nationally. By this measure, home prices nationally are below last year at this time. Interestingly, a few weeks ago, it was closer to 2% down year on year, and now it's 1.5% down year on year. So I'm keeping an eye on this for any indication of price stability. The blue line here is for 2025. And you can see that for a couple of months now, the asking price per square foot for homes on the market has been coming in below last year. At just over $209, prices by this measure are 1.5% lower than last year at this time. Just like inventory, there's a seasonal decline in home prices after June each year. This year, though, prices are more steeply declining than the last 2 years. This is asking price across the country. So these are for homes that are not yet in contract. They will sell sometime in the future. So this implies that sales price weakness in the coming months is in the works. The asking price is already lower than last year. So what we are watching, when we're watching for pricing in 2026, our forecast is for just 0.5, half a percent increase in prices next year. This is a national average, and some markets will be up and some will be down. As we discussed in the 2026 Housing Market Outlook report, there are plenty of scenarios in 26 where home prices are down nationally for the year. And this price per square foot indicator is among the most negative right now. So it's worth watching how this one behaves after the start of the year. Price reductions also imply continued weakness in prices. There are roughly 40% of the homes on the market that have taken a price cut from the original list price. That's more than any recent December except 22. But 22 into 23 teaches us that this one stat that can change in the new year. At the end of 22, things were really rough. Price cuts were everywhere. Buyers were slamming on the brakes at the end of 22. At that time, it was easy to expect that home prices would decline into 23. Sales prices did in fact drop in the second quarter of 23, but then by then in January of 23, we could already see the price cuts evaporating. So the trend started changing in January 23. Mortgage rates had dipped back close to 6%. There was a lot of pandemic cash in the system, so buyer demand picked up enough steam to support home prices in early 23. And that was a surprise coming off this abysmal Q4 of 22. So in this chart, each line is a year. The orange line is the one I'm talking about for 2023. The left end of the chart, early 23, the slope of the orange line was pretty steep down, meaning buyer demand was picking up faster than anyone expected. So fewer price cuts were needed. By February 23, it was pretty clear that we had newfound demand. It surprised a lot of people who assumed that home prices would be crashing into 23. So I will be watching this stat very closely in the new year. If spring demand improves, we should see a steeper decline in price cuts. So what's the difference between January 26 and January 2023? Mortgage rates are 20 or 30 basis points higher now. Unemployment is higher now. Maybe other economic anxiety. I actually don't think it's accurate to say that economic anxiety is dramatically higher now. That was pretty high back then too. But we still had a lot of cash in businesses and on personal balance sheets, so that cash went into real estate. We saw surprising rebounds in places like Phoenix in 2023 after a really sharp slowdowns the year prior. So in 23, there was a lot of optimism that the worst of mortgage rates were already behind us. Now, 3 years later, we realize that was misplaced. So now maybe the opposite gloom hangs over the market. That's what we're looking for, though, in the price cuts after the new year. The newly pending home sales came in at 47,000 for the week, with a recent average of 51,000 single-family homes going into contract and another 11,000 condos. So despite the little dip this week, the sales pace is a couple percent above the year ago levels. In this chart, each line is a year, and you can see that the weekly pending sales, the blue line, are at 3-year highs. So it's the blue line is higher above any recent years at the right end of the chart. This gives us a little optimism for unit volume sales growth in 26. Our forecast for 2026 is 5% sales growth, which would get us to about 4.25 million home sales in the next year. We can watch this data early in Q1 to see if that growth rate continues. It's already in the pendings. In early 25, mortgage rates were around 7%. So much of the first half of the year, the sales rate stayed lower. So if we're lucky and rates stay in the low sixes into 2026, then that represents notably cheaper payments, and I'd expect that to translate into this pending sales data. So keep an eye on this metric after the new year. Okay, that's all the data we have time for today. If you haven't already seen the Compass Housing Market Outlook for 2026, if you haven't seen that report, I'll leave a link to it in the description below. There's a really great website summary where you can interact with the data and see the full conclusions of the report. If you want to download the full report, it's 70 pages of deep research looking at a ton of scenarios and exploring the themes shaping the market in the coming year. I hope you check it out. See you next week.